Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe. All right, welcome everyone. I'm Payne, owner and founder of LivXplore Real Estate and Lifestyle. I have my co-host with me as always, Isaiah Chass. Isaiah, thanks for joining us.
Absolutely.
And we also have Stuart Broughton of Sonoma Mortgage Group with us today. We're going to talk about co-ownership, how to structure it on the real estate side as well as the mortgage side. So Stu, thank you very much for joining us today.
Thanks for having me.
You know what, let's jump into it real quick. You want to talk about Sonoma Mortgage Group a little bit? We haven't announced that.
Yeah, so I broke off from the retail mortgage banking model.
Okay.
It was just getting a little too expensive and narrow as far as products for my borrowers, so I just made the move and run my own business and have way better rates. But I've already been doing this for 3 months, and my business has really picked up, so I really like what I've moved to.
Very cool, very cool. And so you can offer, you made this move, and what can you offer people now that you
So instead of having like a independent mortgage bank that's non-depository, by the way, so you only have one source of rates. Now I can, in the wholesale market, shop consumers' loans to different investors. Right. You have to make sure they can close on time, all that kind of stuff, but experience this over the last 3 months. It's been seamless. I've done a deal with you. Rates are way better. The consumer wins.
Sure. That's great. All right. So that's a whole nother podcast. Right. We're going to talk about co-ownership and co-signing, I guess, on your end that way. And so this is kind of like an evolving topic. So like I would say 10 years ago or even 2 years ago, if I got a call from someone saying, hey, we want to buy a property, we're up in Sonoma County. Often we would get calls from people from the city who are saying, hey, we want to buy a property with a group of friends and create a compound. And often that sounds like a great idea. Isaiah's smiling, everyone's smiling, because we know that usually it doesn't work out. Something blows up as they get into it. Something blows up. There's a disagreement. They figure out, hey, this isn't a good idea. But co-ownership, fractional ownership for owner-occupied homes is becoming more of a thing that way. The name of the company escapes me, but we did a podcast on fractional ownership, and we talked about this. I think in Las Vegas there was a model that was gaining traction that way, and I think you're going to see more and more of this, especially as rates are high and inventory is low, and homes. The entry level for homes is harder and harder. Homes are very expensive. So I think co-ownership is going to become more of a viable model in real estate, and I think it's just something that we should talk about that way.
Yeah, you've had Picasso in the past, which is I'd say that's more of a second home, vacation type model, but there are like the ones in Vegas where it's more of a primary residence model for people just trying to get into a home.
Right. So here again, like the accessibility of buying a home has become very difficult for some. So here's a way that you can still get, you still own the home, you still get that sense of like stability, sense of community. You're invested in the community that way. But it has to be structured a little bit different, but it's a lower entry that way because you're using your friends, family, you're using a group of people that way. So, Stu, why don't we talk about it? Because like the mortgage side, that's the biggest issue.
Right.
It's so what are the issues that these type of buyers would face? What do they have to show to qualify? Things like that. So.
Well, when you combine a group of people, whatever, 2, 3, 4, how many people it is, it's easier to qualify for the mortgage. Obviously, rates are higher now, and sometimes with just an individual, it could be harder to qualify for. So as far as everyone getting together, pooling their funds, qualifying income together, you can buy a single family or 1 to 4 units doing this, and it could help people build equity and qualify for the mortgage and get it done.
Mm-hmm. Right. What about what are some of the issues that I don't think you probably haven't done a ton of these, but you've done some, right?
Oh, I've done quite a few of them.
Okay.
Yeah.
What are some?
The only issues you're going to have is, does everyone qualify, right? What's everyone's credit scores?
Sure.
So if you have someone with an 800 score and you have one of the party members that has maybe a 600 score, that's going to affect everyone else's interest rates.
Sure. So
you got to balance all that out too, right? Where's everyone at? Where does everyone qualify? Give full communication on that. Like what, if the rate's this because of a lower score,
right,
and opposed to a higher rate, you want to maybe have. In a perfect world, you want everyone to have kind of a similar credit score, so everyone gets the same kind of type of financing, right? But that's all stuff that you would look at up front. The paperwork, when you have a bunch of people come together, there's, to qualify, you're going to need all the paperwork from everyone. That could be kind of a pain too, but it's definitely feasible. You can do it as long as you communicate and see the numbers. And does it work for everyone?
Right. I think that's the biggest thing is just everyone being on the same page about their expectations.
Right.
Yeah, I mean, I think like this is still, I think there'll be like mechanisms or like procedures in the future, like people will define how to do this, but right now it still is kind of sticky. So, I would recommend anyone who's trying to do this, like go to an attorney and sit down and maybe put together an agreement or figure these things out up front and spell everything out. So like in the 11th hour, there isn't someone being like, wait a second, we're paying more because you have a
lower credit score
or something like that. So you can put together an agreement and also maybe a way of, I think you have to establish, are you all going to have equal shares of the home, or is someone putting in more money in that way? That's going to influence how you're going to hold title. So I think like, you have to figure that out, and possibly like an exit strategy too. Stuart and I own a boat together, right? And so we have an agreement. We own a boat with a third person that we bought into, and we have an agreement that we bought into, but
that
also
we just cut checks every month.
Yeah,
right?
yeah. We just write checks every month to this boat, and it just keeps just breaking down. But anyway, that's homes are a way better investment than boats. So anyway. But in that agreement, we have like, okay, if one owner wants to exit, there's a mechanism to do that, and you probably want to do that in this situation. So because like, ideally, again, that gets sticky. Like if everyone puts in the same amount, does everyone have the same bedroom? I don't know how that works out, but that's just something personally you guys have to figure out that way. But like, so like if you wanted to, again, this is why you want to get an attorney involved. But like if you had like different shares of a property, you want to hold that like tenancy in common, and that would allow like someone to have 50% of the ownership and two other people to have 25%, things like that. That's going to influence your agreement and how you put that together that way.
And how you establish title, how you hold title, what the percentage is. TIC, tenants in common, is probably the best way to go.
Yes.
But that is an interesting point you bring up with bedrooms, and what if someone does want to get out? So if everyone's on the loan and someone wants to get bought out, then you're going to have to deal with that. Right. You're going to, most people are, that person that's getting bought out doesn't want to be in the loan anymore.
Right.
Do you have to refinance? Where are the rates at during that time? So there's a lot of things to consider down the
exactly.
road if you do partner up with people with that, with not just sharing the space, but, how do we deal with the mortgage? How do we buy you out? Fair market value, all that kind of stuff down the road.
Yeah, I mean, that's all part. It can get complicated. Again, like I would hopefully, as this model becomes more like prominent, I could see like loans available just to buy that one person out or something like that. Or I don't know. We'll see.
Well,
we'll see how that happens.
The case with some models like Picasso.
Yes, where they're handling the financing.
Yeah, they have their own financing. It's financing for your own share, not for the entire property as a whole.
Right, and I could see products like that becoming available because that's the sticking point. I mean, the one thing is like, let's say someone bought something like this when interest rates were low at like 3%.
Totally.
And you
not trying to get out now where rates
and they're like,
are
hey, you know what?
Right.
I have to sell, and the other two owners don't have the ability to buy that person out, so they have to refinance. That could put you in a really tough situation.
Right.
So like again, those are all things that you want to spell out and
up front.
Yeah, and it may be a situation where like you have a group of friends or family or something like that, and this is like, you guys know it's going to be a long-term commitment and it may work, but often like life changes, so like you want to plan these things out. So I do think this is a viable way of potentially it's going to be a more viable way of buying a home in the future, but as of right now it can be sticky, and you just want to like plan for these things, and that's why I think you really have to get an attorney involved that way. So.
Right. Well, especially with units, if you do units like a 2, 3, 4 unit, then that actually works out better, right? So everyone occupies a different unit.
Right.
Primary residence qualifies together.
Right.
And say that hey, Group A the guy wants to get out, one of the members wants to get out. All you have to do is do they want to rent that out? Do they want to keep the property? So in that case, if someone's going to get out, you get a tenant in there. Hey, I'm going to hold this. I'm going to still own this property.
Right.
I want a tenant to go into my unit, and I want to get the break from that.
Yeah.
And still hold the property. So I think if it was a units type of deal, that would be easier than a single family with bedrooms and trying to break that apart.
Right. I mean, that's a great point. And what a great way to build wealth too, where like you go in and you buy units or something like that, and then you put in a tenant in place, and you go out and buy another home, your single family home at that point or something like that.
Right.
That's a really great point that way. Yeah. So another thing to address is like what happens if someone's delinquent on their portion portion of the payment. You probably have to address that. Maybe you have like a little reserve account or something like that to cover incidentals.
I used to run in this in San Francisco a lot of times. So I've been doing loans since 1998, and in the early 2000s there was a lot of TIC financing in San Francisco for 2 to 4 units that were not condo converted.
Right.
So everyone was a TIC on the same loan. So what they were doing is I would be doing loans with some real estate agents, and they would partner these people up. But these people had to have the agreement like, hey, if something goes south, you're still on the hook for these payments.
Right.
So that really, I think, is a good idea to get the lawyer up front and do that. But that was how that was all done before. There was fractional financing that some banks did where there wasn't condo converted, and they would just finance that one unit, which it's hard to get financing now on that. But that's how that played out. But you get two parties that don't know each other, all of a sudden they're buying a house together. That's what they were doing.
Yep. Yeah, exactly. So it's going to be those type of agreements that we need and those processes put in place. Like I said, San Francisco's always had expensive housing, and that's why I think that model came in, and now we're just going to see it in other places that way.
Right.
So like in regards, like in those situations, what type of relationship does someone have to have with someone? I remember in the past when we've done deals where like I want to say the language for a conventional loan was like, you had to have a lifelong commitment or relationship with that person. Is that no longer the case?
Oh, you're talking like a gift, like a form of a gift?
No, I was talking about like, when friends were buying properties together, like I want to say like we had to show that they had like a lifelong commitment or friendship or something in order for them to qualify. Is that not the case, or is it?
No, I mean that sounds more like maybe a gift. Like gift, you have to have a family member in order to fund, give the gift of money towards the down payment. But I think as far as just from conventional financing, whether it's FHA, VA, whatever it is, or conforming, you're not gonna. Those people can go together without any of those restrictions.
Okay.
Right.
Okay, cool.
So I want to take VA out of that, not VA, but FHA and conforming.
Right. Okay, cool. Well, I think that pretty much kind of covers the basics of it. If you guys have any other questions, please reach out in the comment section. Do you guys have anything else regarding that process?
No, it's definitely on the rise. We see new companies having models like this every other week. Something new coming up.
Well, I put this podcast together. It's just like just be aware of it, because I think there's going to be more potentially loan products and just like more models coming out like this that may allow for people to get into to home ownership that way.
Mm-hmm.
So
certainly as affordability becomes more difficult.
Yep, exactly. So cool. Well, thank you guys for joining us. I'm Sean Payne, owner and founder of LivXplore. Isaiah Chass, our founding agent and co-host, and Stuart Broughton of Sonoma Mortgage Group. If you have any lending questions, this market's crazy right now. Rates are high. You need someone experienced, and I strongly recommend Stuart Broughton. So, Stuart, thank you again for joining us.
Thanks, guys.
And until next time. If you like this episode, please hit like and subscribe. Thanks. Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe.